Please subscribe, like, and share. It really helps us out. And of course, if you have any questions, comment below and we will answer you as soon as we can. Hey everyone. Welcome back to our accounting series. Today, we're talking about an important concept, depreciation of fixed assets. By the end of this video, you'll understand what depreciation is and why it's necessary. The two common methods of calculating depreciation, straight line and reducing balance. How depreciation affects a company's financial statements. Let's dive in. Depreciation is the process of allocating the cost of a non-current asset over its useful life. Since fixed assets lose value over time, businesses must account for this reduction in value. Think of depreciation as wear and tear, just like a car loses value the moment you drive it off the lot. So, why do we depreciate assets? Firstly, fixed assets do not last forever. Secondly, it ensures that the cost of an asset is spread out over the years it's used. Thirdly, it gives a more accurate representation of a business's profits. An example of depreciation would be: a company buys a machine for $10,000. After 5 years, it will be worth nothing. Instead of recording the full cost in year 1, we spread it over 5 years. This is depreciation. There are different ways to calculate depreciation, but two common methods are: firstly, the straight line method. Spreads the cost evenly over time. Secondly, the reducing balance method. Depreciates more in the earlier years. The straight line method is the simplest way to calculate depreciation. The asset's cost is reduced by the same amount each year. The formula for calculating the depreciation: annual depreciation equals the cost of asset minus the residual value divided by the useful life of the asset. An example would be: a company buys a computer for $5,000. Its expected useful life equals 5 years. Its residual or scrap value equals $500. Therefore, there would be $900 depreciation per year. This means the business will record $900 as an expense every year until the computer is fully depreciated. The reducing balance method applies depreciation as a percentage of the asset's remaining value. This results in higher depreciation in the early years and less later on. The formula is as follows: annual depreciation equals the net book value multiplied by the depreciation rate. For example, a company buys machinery for $10,000. The depreciation rate equals 20% per year. The year 1 calculation would be $10,000 multiplied by 20%. This is equal to $2,000 for the first year. Then the new book value would be equal to $8,000. For the year 2 calculation, we would start with $8,000 and multiply it by 20%. This is equal to $1,600 for the second year. Why use this method? It is more accurate for assets that lose value quickly at the start, like vehicles or technology. This method is better for assets that generate more revenue in the early years, such as new machinery that is most productive when first purchased. Let's summarize what we've learned. Depreciation spreads the cost of a fixed asset over time. The straight line method applies equal depreciation every year. The reducing balance method applies a percentage, leading to higher depreciation in early years. Depreciation affects both the income statement and the balance sheet. Understanding depreciation helps businesses plan for future asset replacements and report accurate profits. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more accounting tips. Have any questions? Drop them in the comments below. See you in the next video. Thank you for watching our video. Please like, subscribe and share. And comment below so we can clarify things for you.